Tom, what's your take? Is it nerves?
Morning. Well, I think there's clearly a disparity going on between small caps, which have had such a huge run over the last year or so, versus the large caps. In the Chinese New Year outlook that we did recently, we actually pulled India back to neutral just on some concerns around valuations and also some of the drivers around retail investing. But I still think, India long-term good structural story. It can't go up parabolically forever. So I think, maybe we need a little bit of a reset here. But I think still structurally, the growth story, the demographic story in India is very interesting. So I do think, foreign investors will be continuing to buy Indian equities. We've actually seen quite a bit of outflow year to date in Indian equities. And for us, actually, at the moment, we're looking more at India bonds than equities at this point.
Tom, it's not just growth, it's 8% growth. So given the sell-off that we're seeing, should you be buying the dip or wait a little longer? There'll be more correction to come.
Well, I think it depends, obviously, on your investment outlook. Most of our investors are very long-term holders. I think we could see a correction given where valuations are, but it's not that dissimilar to a lot of markets we're seeing at the moment. Valuations are getting stretched. As you said, 8% growth in India is very, very appealing. The long-term structural drivers look very interesting, and also the earnings growth there has been very strong. So I do think any decent-sized correction, foreign investors will be moving back into that market.
You talked about liking Indian bonds right now. What are you liking? What should you be picking up?
7%. That's what I'm liking on the Indian government bonds. I mean, number one, yeah, it's pretty simple. I mean, you're getting very good yield there. We've got this new inclusion process into JP Morgan EM index. Foreign investors are very underweight, and also in terms of correlations with other bond markets and equities, it does give good diversification in the portfolio. So a couple things: underowned, very strong yield, and diversification play. So I think there's a lot to like there.
Overall, the market's looking to the Fed and what's expected from the Fed and the messaging next week. How are you anticipating? What are you anticipating? What are you hoping to hear?
Well, it does seem that, given some of the inflation data we've seen just this week, there is a pretty strong potential of the dot plot being moved to 2 rate cuts for this year. So 3 to 2, what kind of impact will that have? Obviously, the Fed is not expected to cut at this particular time, but they will give some indication as to forward the forward look on their dot plot and what the individual members expect. So, if we move to 2, then clearly that will have a little bit of an impact on markets. U.S. dollar, I think, will strengthen a little bit on the back of that. But as it is, we've already gone from 6 to 3, so 3 to 2. How much impact that will have, I'm not exactly sure. As I've been saying all year, I think the outlook now is more around volatility on equities and growth. What's the actual impact, drawdown impact on growth, both from GDP and also from earnings versus rates and inflation and volatility that we had last year. So that's kind of how I'm looking over the next couple of months.
Are investors reassessing risk, Tom? Because when you take a look at gold, which traditionally is a haven play, it is at record highs. It is higher than what the dollar suggests it should be. How are you looking at risk right now?
Yeah, I mean, there's a lot of disparities going on in the market, right? On the one hand, you see global growth slowing, decelerating, exports coming down, inflation still a little bit sticky, and on the other hand, you have these kind of pockets which continue to move up. Mega Cap 7 obviously is the big one, but India, as we mentioned earlier, Bitcoin, gold. Gold is interesting. I mean, gold is something that we like along with commodities as kind of a safe haven play. If you look at the disparity between central bank buying of gold and ETF buying, there's a huge gap there. So I think at some point ETF investors will actually come back into gold markets. But I've liked gold all year, and I continue to like it into the future because there are risks in the market, and I think investors need to have a very diversified playbook at this moment.
If there is one rotation to make, what would that be, Tom?
Well, It's obviously very hard to call, but in terms of the mega cap U.S. equities, we are talking about rotation there. We're not saying get out of U.S. equities, but I think certainly there is a case to take some rotation in those markets into some of the lower beta exposures or equal weighted type of exposures. I think, if you look at the earnings growth has been very, very strong, but projected earnings growth for some of those companies or those 7 companies over the next year is around 30%. I think that's very optimistic. So, I think particularly going into the second half of the year, of course, we have election risks. Will there be some kind of AI regulation? We don't really know. But I think, now is the time to start looking at possibly rotating some of that portion of your portfolio away from some of those tech names.